Good afternoon, everyone, and welcome to today's webinar on the coronavirus. We will be focusing primarily on the oil demand side of the spectrum, as well as adding a few nuggets around what's happening on the supply side in reaction to this specific issue within the oil markets today. Before we get started, my name is Ian Niebuhr. I come from the RS group here, and I've been working with the oil team here for a number of years. With that, I'm going to kick it off, and I'm going to pass it off to Al Salazar, who covers demand here. And maybe just to start, Al, could you take us through how the coronavirus has spread and maybe how the oil market has been reacting as a baseline?
Thank you, Ian. Well, let's start off with an infection chart here. The rate of infection in Hubei province started accelerating in mid to late January. Right now, we are sitting at just over 80,000 people infected in China, 60,000 of whom are in Hubei province, followed by Guangdong with just over 1,000 infections. Now, I segregate Guangdong because it is responsible for roughly 11% of Chinese GDP. And as time progressed, to control the outbreak, Chinese authorities put Wuhan under lockdown, followed by other cities. Recently, the rate of new infections in China has slowed, while lockdown restrictions have been lifted in numerous cities. We saw a rally in crude prices 2 weeks ago. However, last week, global markets started selling off strongly on fears related to the rise in infections outside of China, which today sits at just over 16,000. So you can just see there, and that's basically concentrated in South Korea, Japan, and in Italy.
All right, so we know that China has been the epicenter for this disease outbreak to date. We also know that Chinese governments have instituted all sorts of measures from lockdowns to travel restrictions, et cetera, to really try and contain that. How much of China's oil demand really has been affected so far?
Great question. Well, first of all, it's important to know that data on the Chinese economy and oil demand are opaque to begin with. And second, there are no real-time oil consumption data for the country. All analysts suffer from these data deficiencies. In the face of this, we developed our own methodology to estimate the potential impact of the coronavirus on Chinese oil demand. First, we estimated the amount of gasoline and diesel consumed in each province of the country under normal conditions. We then defined this as the consumption at risk in each province in the event of a lockdown. We then looked at the infection rates in the different provinces and cities to come up with a scenario for staged government lockdowns in parallel with the spread of the infection. Stage 1 is the actual lockdown in Wuhan and is the epicenter of the outbreak. Stage 2, in orange there, includes lockdowns in Guangdong, Shanghai, Zhejiang, the provinces and city reporting the next highest number of infections at the end of January. These places were eventually locked down, but then recently the lockdowns were lifted. Stage 3 extends the lockdowns to Hainan, Hunan, and Anhui, neighboring provinces to the epicenter, reporting significant amount of infections, while stage 4 is basically 700 million people. It's not basic, it's half the Chinese population are in lockdown. So with all this, based on the number of people we think are in lockdown, either involuntarily or voluntary, we think that Chinese oil demand is easily shedding over 1 million barrels a day in the current quarter. But looking beyond China, now this is the important thing, we estimate total world oil demand this year may grow a modest 600,000 barrels a day because of the impact of the coronavirus. This estimate is based on a loss of 1 percentage point in global GDP growth this year compared to the pre-coronavirus case. Now, how did we get this? Well, this loss of 1 percentage point is midway between the estimates released earlier this week by the OECD for its best and worst case scenarios for the impact of the virus on the global economic activity, with the best case being just a 0.5 point reduction this year, and the worst being a 1.5% reduction.
All right, so before we get to some of that forward-looking view in a broader global pandemic, I still want to touch a little bit more on China. So one of the things we've seen is some really wide-ranging estimates from up to 5 million barrels a day of Chinese oil demand being wiped out. But also some estimates are much, much lower than that. So there's a lot of uncertainty in the market. Can you kind of comment on where you see some of the big uncertainties and why there is such a wide range, even for China, where it's a little bit more in the rearview mirror?
Absolutely. It's been really a free-for-all. At this point, there is no authoritative count for how much Chinese oil consumption is offline. International agencies such as the IEA lag reality by a few months and is typically revised for many months afterwards. Some analysts point to drastically reduced Chinese refining runs, reduced Chinese imports, and other one-off measures, but the problem is that none of these necessarily equate to actual consumption. Lastly, and I don't have to remind everybody of this, the situation is very fluid. Total infections, for example, since we released our first report in late January of COVID-19, have increased tenfold.
All right, so looking forward, there's a number of leading indicators, obviously, that we're focused on. What are some of those indicators that you're following, and how does that shape your view?
Okay, great. For starters, there's the Chinese Purchasing Managers Index. For us, PMI leads global GDP, or in this case, Chinese GDP, and GDP is well correlated with oil demand. Recently, we saw Chinese PMI drop to 40.1 in February from 50.3, which was expansionary in January, which is a clear, loud warning about Chinese manufacturing sentiment deteriorating. But second, there's something that is available publicly, and it's called TomTom's Traffic Congestion Index. TomTom is a company that makes GPS devices and has developed a publicly available traffic congestion index. And what it shows, so on the chart there on the left, stage 1, is that for Wuhan, traffic is 40% less congested versus the same period last year, and there's no improvement there. But look at stage 2. Look at this, and then you can see that there's more congestion since mid-February. Everything's trending to going back to normal, and there are some cities that are actually, you could consider, are back to normal in terms of traffic congestion. Now, if you flip on to the next slide, stage 3, in our stage 3 group, there's only one city there that reports, but as of February 20th, when people were going back, you can see the congestion increase. Stage 4, that's the rest of all the provinces that we named, and generally the trend is increasing. So in the past 2 weeks here, we've probably seen a 10 to 20% improvement in, increase in traffic congestion. So overall, these data suggest that Chinese gasoline consumption this month, March, should be higher than it was last month. And if the current trend continues, gasoline demand might even be back to normal sometime in the second quarter. Another thing that we monitor is, next, if you take a look at this one, is Chinese power consumption. For a selection of cities and industries, this index, which we've taken from the state authorities, shows that power demand is roughly at 30% of last year's levels, as reported on February 18, but was reported to be improving slowly. And again, there's other things like port congestion. There's anecdotal reports that's saying that port congestion is easing as people are going back to work. And another thing that we looked at early on was air quality indexes, as we suspected that a reduced mobility in China would lead to improvements in air quality, which has recently been since confirmed by NASA. And lastly, we stretched out to our satellite data, where we look at flares and heat sources over China, indicating any signs of activity. So there's a lot of things that we can look at in terms of trying to gauge of how bad things are.
So just to touch on that a bit more, because I think your earlier point was that there's a lot of lags in other data sets. Like, how real time is this, and how recent is the data point you're showing here? Oh,
the TomTom data is as of like by the hour, so you can't beat that in terms of metrics. If I look at the power consumption, well, that's reported sporadically as we get the reports come in. The container reports is daily. If you look at the air quality index, that also is daily, depending if they decide to report or not, because it's a bit sporadic. And the satellite data, again, is like daily. So these things, when we look at Chinese traffic congestion, I don't think people are actually pricing that in the market that has returned already. I mean, that to me is a distinguishing and almost counter consensus viewpoint at this moment that, hey, things may be back by Q2, which is really flies in the face of no demand growth for this year.
So that kind of takes me to my next question here. As we look to the next couple of quarters in China, which is obviously a much more significant part of the global economy than what we would have seen in previous outbreaks of diseases, what are your expectations? What should we be looking for?
Well, first, like I mentioned, TomTom and the power resumption indexes that we're watching, I fully believe they'll trend towards normal. I mean, and we think that obviously it gets sometime in Q2, or and second, it's important to note that President Xi, he's pledged to meet this year's economic targets and China's obligation under phase 1 of the US-China trade deal. Despite the corona, despite shocks to the corona-driven shocks to the economy, a significant catch-up in industrial activity to achieve this. So it's also worth noting that China has a history of persevering under difficult economic conditions. Let me take you back to the Great Recession. During that time, China's government deployed significant stimulus focused on infrastructure builds. And also, I'm not sure if folks recall, but China's had weathered several stock exchange collapses since 2015, which had limited ripple effects outside the country.
So what do we know about the real-time impact of the spread of the disease outside China and economic activity and oil demand more globally? Because that seems to be like what's front and center in everybody's mind right now.
Absolutely, and this is the greatest source of uncertainty right now. With China bouncing back, it looks like an activity. Everyone's focused on the uncertainty in the globe. So one of the metrics and one of the headlines that you'll always see is, XYZ company airline is shutting down flights. Well, here we have a metric of global daily flights. Now, this is very noisy data, and it shows that the 7-day moving average is roughly 4% down relative to the period prior to the COVID-19 outbreak. But there's a bit of a pattern here. So I like to call it the W recovery. You have that, around the corona, or sorry, the Chinese lockdown, you obviously had the big hit. Then you had the resumption, which I think is basically a temporary recovery as airlines follow through on their committed flights. And now the airlines are adjusting their flight schedules because nobody wants to fly anymore. So we're basically a W recovery, which once the virus subsides, flights and jet fuel consumption should recover. Now, another thing that we've looked at in terms of the world is electricity consumption data. On the left, I have Japanese power demand. The solid green line is our actual demand. The pink dotted line is the forecast. And what we've done is we've weather adjusted it. And it shows that, actual demand is not really showing a decline that you would expect given, the COVID outbreak. It's basically within the error. Meanwhile, South Korea is actually using more power now, weather adjusted, so there is no COVID impact there. Now, the next slide, if you flip to the other hotbed for corona is Italian power demand. Now, this is less weather dependent, but again, I don't see any drastic drop off in electricity consumption. So when we take a look at that, and another thing, you could also go to the TomTom traffic congestion data, and there's maybe a mild decline in Milan congestion, but it's nothing comparable to what you see in China. So overall, I would say that given the relative non-event in power and obviously the TomTom congestion data not showing an easing up of traffic, that the overall global impact so far looks like it's nowhere near what's happening in China.
So, I mean, if you've been paying attention to the news or hanging out on Twitter, you certainly have noticed a lot of really scary headlines out there, and talk about the disease spreading and some very dire prognostications about the potential impact on the economy. We also noted that we're about 600,000 barrels a day of year-on-year demand growth this year, which is on the higher end of some of the numbers I've seen. How do you square that? What do you think people are missing, and why is our view a little bit more optimistic than maybe some of the others in the marketplace?
Absolutely. I mean, it gives, right now with all the uncertainty, it really is a bit of a free-for-all. Media coverage, we feel, has been skewed to the negative, and positive news is not getting reported as widely or in on equal basis. For example, I mean, when I talk about the traffic improving in China and the port congestion falling, I don't see many people talking about that on Twitter or on regular news feeds. And another thing is China passed this antiviral drug a few weeks ago, and it's already going human trials in China. They don't have to wait for a year. And one thing that I want to point out is that I think our view is measured. It's basically taking in the fact that we think Chinese demand looks like it's probably coming back sooner than many expected. And lastly, I want to discuss the notion of pent-up demand, because I compare it to like an elastic band. You have the Chinese consumer, really, that's been held back for about a quarter, and then once the coronavirus begins to heal, they'll want to consume that durable good they weren't able to. And then you're also gonna, how do you say, wind aid that with stimulus, positive stimulus. And the world also is responding globally with coordinating stimulus measures. For example, the Fed lost half a percentage point. So if I look at a 600,000 barrel a day growth for this year, I base it on the fact that we believe China is turning around, and that we believe that, obviously there's some uncertainty when the virus will heal, but we're right down the middle in terms of expectations of what the impact on the global GDP is. And I really don't want to leave out the combination of pent-up demand plus stimulus.
So just to finish up, maybe with the story changing so quickly, what are some of the things that you're looking for or going to be paying attention to over the next couple of weeks that maybe some of us could go and track down?
Well, obviously all the things we discussed about tom-tom congestion, the power, all that's public. But I know a lot of focus is on global recession. So things in my mind are following up on consumer confidence, retail sales, and the focus in Italy and Germany. I mean, there's going to be some pretty bad Chinese auto sales number coming up, which is directly impacting, German economy, because 50% of Volkswagen sales go to China. So can Europe weather that, right? And how does the other manufacturing industries, and how does the sentiment play out there? And in terms of the US, with the outbreak that we're seeing there, really pay attention to consumer confidence, because ironically, in February, US consumer confidence improved, right? So, and the US consumer is a pretty big portion, like almost 2/3 of US GDP. So in order for you to get a global recession, in order for you to get bearish, no growth this year, you have to have a pretty significant combination of negative downward forces, and it's kind of hard to imagine, especially if China comes in, recovers.
Gotcha. All right, well, we've got a lot of really good questions coming in here, and I'm going to consolidate some of those, and we'll come back to them, after Sarv's had a chance to share his side of it. And so with that, I'd like to pass it on to Sarv Ozkan, who spends a lot of time looking at the supply side, and we'll touch on some of the impacts that we might see from the coronavirus in terms of supply outlooks.
Yeah, hey, thanks. So just to get kicked off here, I'm just going to touch on some of the things that we've seen in operator earnings call season with regards to their thinking, given this slowdown in demand, which as we heard from Al, we're optimistic that it is coming back, hopefully in the second quarter. But it has made it into the earnings call season in different shapes and forms. For example, we heard yesterday from Exxon that they are actually going to be taking their expected growth number for the last 2 years down 10%, just because they're not happy with what the prices that they see out there in the market, although they are keeping their longer term plan of almost tripling production in the Permian Basin intact. So that's just one example, but we saw Centennial saying that they're going to be prioritizing balance sheet preservation over production growth. We saw Continental saying that with demand impacts on the coronavirus, they're going to be moderating their near-term growth and waiting for that demand the pent-up demand that we talked about to show back up. On the Oxy side, they said that they're going to remain flexible. They could lower their growth, go no growth scenario, or even let production decline a bit. So again, free cash flow is king, and they're going to live by that. Cimarex, again, saying we're going to be living within cash flow. So if we don't spend the capital, does production go down? Of course it does. So they are saying that they're going to play the wait and see game, just like the others. Cabot is, prepared to cut capex should they see further further deterioration in market conditions. And then a quote from the oil field services side that are saying that they're actually seeing a couple of rigs that they had planned to keep out there coming back to them from operators who are reducing their drilling program in the light of commodity price changes. So that all of that stuff is going to impact supply, of course, and everybody is in sort of wait and see mode. So if we do see demand start to come back in the second quarter, we expect that a lot of the plans that operators had in place are likely to continue and even maybe pick up steam later on in the year as prices recover. However, even before we got to the impact of coronavirus on demand, we already had all of these operators collectively shedding about 15% or 8.8 billion of capex from 2019 levels, and they were open to further activity reduction should prices deteriorate. And we saw in those comments that those are the things that they're sort of watching for. We don't believe that any of these public operators are going to go and change their plans after they've guided to the street what they're going to do, at least in the first quarter. So they will likely wait to see if the situation has picked up before next earnings call season, and if it hasn't, they might be open to further reducing capex activity, but otherwise, I think they'll keep their plans intact should the demand worldwide pick back up to normal levels, as we're seeing in a lot of the data that Al showed. So to discuss the supply impacts and just the general fundamental balance, bringing the supply side into the equation, we're going to have another webinar next week to discuss all of those impacts. But for now, I will go ahead and pass it back to Ian to sort of go through the question and answer session, and I'll leave this slide up for you so you can contact us to learn more or schedule a custom demo of our offerings and our research reports. Please feel free to email us at businessdevelopment@enverus.com, or feel free to give us a call on the number on the screen. So with that, Ian, I'll pass it back to you.
Thanks a lot, Sarp, and I'm going to pick on you first. There's a couple questions here that I think you tried to answer, you did answer, but probably bears a little bit of clarification. Do you have a sense of like how much this capex cut or shift in activity really was associated with like pre-coronavirus, and then separately is actually a direct consequence of coronavirus?
I would say that most, if not all, of these capex cuts were pre-coronavirus. These plans were set in motion to cut capex far before the coronavirus development, going into the fourth quarter of last year. Everybody was already thinking about how they're going to live within cash flow and how they're going to need to get more efficient, to get more return directed programs in place rather than growth directed programs in place. So this capex cut, these capex cuts that we showed on the previous page, were all expected. So I don't think that the coronavirus has yet played a role in these capex cuts, and the chances of it actually playing a larger role than what we saw from Exxon is slight should the demand come through and recover, and next earnings call season we're likely to be thinking about that a lot less than we are today.
Perfect. Now that's really helpful clarification. Al, you're up next for the firing line.
Yes, sir.
So, I mean, there's a couple questions here, and they're ones that we've debated internally, I think, a lot. And it's sort of reconciling the optimism, and it's not great optimism, but subtle optimism in our view, against some pretty dramatic steps taken by the Fed, for example, and others to try and bolster the economy. How do you square those views?
Well, we live in absolutely uncertain times. This one person made a very good point that the economic recovery doesn't begin until Corona begins to heal and correct itself. Obviously, we look at historical comparisons of how viruses have lasted. It's not perfect, but everyone has to remember that viruses are transitory issues, right? Which leads to, again, pent-up demand. Another thing that I look towards too is that we had a very bad year for oil demand last year, very bad, 880,000 barrels versus like a 10, 15-year average of 1.2. So the bar to beat last year is quite low. Another thing also that I like to point out too is that, Q1 absolutely is going to be horrible in terms of year-on-year demand shock. Q2 might have a little bit less of a shock, but there'll still be some negativity involved in there. And if this virus subsides, and then you get the second half of the year, it becomes bullish with monetary policy and pent-up demand, I think these are the ingredients of at least a modest pickup of 600,000. Like 600,000 is not great. Like, let's be clear, that's not great. That's 1% GDP reduction in global GDP is not nothing. That's a significant hit. And when you look at the scenario that we plugged into our models, the IMF was calling for 3.4 as of October, taking 1% off is 2.4, and the 20-year average is 3.3 or 3.2. So that's a pretty significant hit. That's no joke, right? In terms of a hit. So 600,000 to me is plenty bearish, and a million or having zero growth for the year is basically assuming that this develops into a wild pandemic and that we're at the very worst case scenario, right? Where pivoting consumer confidence ceases and a couple economies go into a recession, major economies, but not something coordinated globally. Does that help?
Yep.
Thanks.
So there's a couple of good questions about data and confidence, and I think it gets back to the wide ranges and uncertainties we see. And this may be an unfair question, but how do you think about and how confident are you in the numbers that are reported specifically out of China when you have on one hand the sort of state data and the other hand these widely circulated pictures of nobody on the street?
Well, one thing that I learned is that price doesn't lie, and during Q1, obviously there's outages, but Brent was still backwardated, right? And when I look at the data, if you try to isolate and close your eyes to Chinese data and look around and see what other strains in the economy are we seeing, is it reflecting it? If Chinese demand is truly off 5 million barrels a day and there's no impact in January, and there's all in February, that must mean that must be 10 million barrels a day off. Where did the inventory build go, right? And if you look at Singapore inventories, they've drawn, floating inventories have drawn. Some of that could be just Chinese hoarding this stuff. Overall, when you look at the entire picture, this is why it's so difficult. This is why I think the range of estimates are all over the place. Nobody knows how much of a hole we have to dig ourselves out of to recover. But I still place faith in the TomDom data because that's subjective. I mean, that was there before. I place faith in some of the real-time metrics that we have. But in terms of the measurement of actual fuel consumption, I still hesitate when I see that. I hesitate because nobody knows. I haven't yet seen this amount of gasoline was burnt on this day. I mean, the closest we've seen to that is the EIA data.
And so, Sart, I'm going to go back to you. And Al said one of my favorite lines, it's price doesn't lie. And you showed this great slide about capex reductions across a number of the key operators in the space. Can you just put in context what sub $50 oil and sub $2 gas really means relative to some of the context they were presenting these budgets at?
Yes, definitely. A lot of these budgets were set in place at $50 to $55 oil and $2+ gas. And today we're sitting sub both of those levels. So in a lot of cases, the price is already forcing operators to think long and hard, and coronavirus is a way to bring that conversation up without saying the dreaded we can't generate free cash flow at these levels line. So today I think a lot of operators are looking long and hard at where prices sit and are hoping for a recovery, because if prices don't recover to the ranges that these particular plans were set in place at, they will have to make some adjustments, cuts, and drop rigs and activity, and further cut expected guidance numbers for their volumes come Q2.
Gotcha. And so I guess a follow-on of that, I mean, we make a lot of the capex cuts that I think many of us have noted. Do you have a sense of how directly that's translating to activity? I mean, there's been a long underlying theme or historical theme of efficiency improvements. Do you still see that in place?
Yeah, I do think that some of the capex cuts and the activity that takes off the table will be offset by some efficiency gains. A lot more drilling in core areas with more of a development plan, pad drilling, those sorts of things, time to drill. I believe those will impact productivity, hopefully to the upside. But in this particular scenario too, we have to keep in mind that as we move to development mode in a lot of these plays, we have seen the impacts of parent-child wells, and we've seen some areas actually post deterioration in type curves. So those two things will be playing against each other, I think, to sort of figure out where we're going to land in terms of productivity gains or efficiency gains, and degradation from non-scientific spacing tests, right? So should our operators be able to actually address spacing as more of a science rather than a science experiment, then we should be able to actually mitigate a lot of the interference issues and space correctly, and actually see a bump in productivity again this year, although we have a lower capex spend across the board.
Gotcha. So just coming back to you, Al, I mean, there's a good question here. I'm not, super familiar with these superbugs and the like, but how is what we're seeing right now compared to some of the other epidemics that we've seen in the past, whether it be SARS or swine flu or others?
SARS, I remember in early January, it came to me and we saw this first release. The first thing I looked at was SARS, and the infection rate for COVID-19 has blown through that. So I really can't use that as an analog. Some people will say, well, take a look at H1N1. We were just looking at the stats yesterday, and reconfirming 60 million people globally were infected, 12,000 died in the US over a year. So that may be comparable in 2009. 2010, but to isolate the economic impact of that is tough because that was post-recession. It's a bounce back. So I think it's a one-off. It's new. Judith, do you have any things that?
Yeah, and I might just add that this is unique in that we have not seen major lockdowns in China in previous episodes of epidemic outbreaks. We didn't see the extent of closures and businesses sending folks home to work remotely in previous outbreaks. So while the infection rate, maybe there's no a comparable historical analog, there's also no analog for the prophylactic measures being taken by governments and businesses to contain the contagion, which again makes it more difficult to try to come up with best estimates for the potential impact on economic activity.
Awesome. So there's a couple questions here that are, I think, the obvious questions, and we're going to sidestep them today. But it's really around, what's happening with natural gas markets, especially in the light of, decline in drilling and liquids and oil-directed drilling. What does that mean for prices and balances there? We have a great team here that spends a lot of their time focused on that, and we'll be addressing that in an upcoming webinar as well. There's also a second question around OPEC and sort of what do our liquid supply balances look like in the face of our demand numbers, some of the supply effects that we've discussed here today, and the more detailed work we do as a team as well. This will also be addressed in an upcoming webinar quite soon here as well. And critical questions. And for those of you who are clients, we're happy to discuss those things for you in the short run as well. Still got questions coming in here. There's another one for you, Sarp, and I'm not sure if it's in your wheelhouse or not, so please forgive me if it's not, but it's around some of these sort of peripheral entities, whether it be the MLPs, energy infrastructure companies, services. Have you heard anything yet in the dialogue and narrative of those companies related to this development in the oil market and how that's affecting their businesses?
Yeah, I mean, services certainly. I think one of the quotes that we put up was from a services company, oil field services company, and they are seeing the impact of these capex cuts and lower prices. Mean some of their rigs that they had planned to be out in the field are coming back to them. So their fleet utilization will definitely be suffering from those operators, especially that are more flexible than the public guys that have to guide something to the market, right? More PE-based private operators that don't need to sort of conform to their plans on a quarterly basis. I think those are the folks that are going to be dropping their rigs, right? So on the oil field services side, those impacts will definitely be felt and have started to be felt even from a midstream and an infrastructure perspective. I think what we have to really think about is that every single barrel of oil growth in the United States that we've had since the middle of 2016 has been being exported. So the midstream infrastructure that fuels the move of oil and liquids to the coasts, and then further on to end markets and refining markets in other parts of the globe, has certainly been impacted as some of that demand in Q1 has been negatively impacted. So definitely we've seen the utilization of that infrastructure is definitely not at the levels that we had expected prior to the impact on demand that we saw from coronavirus. So definitely there has been knock-on effects, although storage hasn't done too bad in this particular time. So hopefully that addresses most of that question.
Thanks. So a couple data questions here, just for cleanliness. Al, around the flight data that you showed on that slide, is that
Yes.
How long a history is it? Is it daily, or what are we looking at?
That's daily data that goes back to the beginning of January. So every day, go to Flight Radar 24, and it tells you this is how many flights are up in the air right now. That's day, and we've been tracking it ever since, and it's been quite useful.
And then one more question. I mean, we got the TomTom data for China, and I think that's been a really useful way of looking at what's happening there. Have you looked at that data in places like South Korea, Japan, Italy?
Yeah, well, they don't have it for South Korea, which is kind of weird. Italy, it's all there, and like I said, Milan is maybe showing a little bit of easing of congestion, but the rest of the cities, I'd say it's pretty normal. Japan, nothing there yet either. It just doesn't seem like it's making an impact on the traffic yet.
Does that amplify or change your interpretation of the Chinese data at all?
If one thing, it kind of highlights the difference between a lockdown and the difference between consumers actually changing their physical driving habits. I mean, I don't think you're there yet in these other countries to say it's not making that much of an impact yet, according obviously to the electricity and the power data. Meanwhile, lockdown, that was a pretty significant measure. Thank you. And one thing I want to mention is that if there's any country in the world that can successfully lock down its country, it's China. And if there's any country in the world that can say get back to work equally, it's China. That's both reverse. Like, I mean, those directions go both ways.
One more clarifying question is the impact on jet fuel demand. We looked at that specifically.
Yes, so that's built into our numbers. And at the very beginning, we thought it was 250,000 barrels a day, at stage 4 equivalent. And I'm still sticking to that number. The flight tracker will be quite key to that. And just to add to the complexity of all, I just want to add this in, is that when a flight leaves China, that jet fuel is booked under Chinese consumption, and then when the return flight is, the jet fuel consumption is booked in that country where it's coming back from. So we've allowed for that, and it makes it really difficult. So that's why we kind of gravitated to the total number. Like global jet fuel consumption in kerosene is 8 million barrels a day, 250,000 barrels off that. You do the math, it kind of equates to what we see in terms of the weekly outage. Now, obviously, with the American Airlines, I think, announced a 20% reduction in flights. Well, those are things that we're going to be factoring in our estimate as we go forward.
Should we be looking at different things for North America and Europe as proxies for shifts in demand? And I guess the context, there's a few questions here about like anecdotal stuff people are finding at home, like not being able to get, hand sanitizer, or people buying stacks and stacks and stacks of rice. It may look a little different and feel a little different here in North America than like full lockdown in a place like China. How might that shape up a little differently in the figures if we were to look at this in a couple years?
I fully suspect that if you have hoarding, it's going to show up in retail sales for the month, and then after that you're going to get to some type of depression, where nothing happens. So that's how it's different. And the lockdown measure, that was historic. In the United States, you need this crisis of consumer confidence, this panic, and that itself, once you see the store shelves empty, you might see this pickup, like I said, where people start storing their stuff. And then after, another thing, gasoline, weekly gasoline numbers. That would probably tell you if something picks up abnormally, adjusted for all the things that you can adjust for. Because in a hurricane, what happens? People stock up, they fill up their gas tanks, right? I mean, obviously, this is a longer duration than a hurricane because nobody knows how much it is, but you might see some distortions.
The other thing is that data, especially for North America, but also Europe, on refined product demand is much more transparent than in China. We can get weekly data on send-outs from refiners and wholesalers, weekly data on storage numbers. So it's much easier from the point of view of what economists do to draw a bead on what's actually happening in real-time demand, looking at the actual commodities as opposed to shadows on the wall like the TomTom index.
Yes. I mean, the power demand is a perfect example. You can't hide from that. That's like every 15 minutes, every hour, every day, right? If anything blinks, you'll see it there. Right?
What about substitution effects of shifting from flying to driving?
The only substitution effect that I find fascinating right now is for whatever China's losses in manufacturing, has it picked up in places like Vietnam and maybe Southeast Asia? And that to me may dull the ultimate impact here. Like, people are guessing on the GDP impact, but I have yet to see, any type of compensation for other things. I mean, a lot of people have made, there's a supply chain impact also, but that's the only thing I can think of in terms of substitution at this moment.
Gotcha. All right, well, I think that's through most of the questions here. There's a couple that I've left off, and we'll try to address those more directly either in a future webinar or reach out to you directly afterwards. It's just that this team in the room here isn't necessarily the one to answer those questions, so I apologize for that. With that in mind, I guess, sir, there's a quick question if we could see some of the statements being made from the industry leaders again, just to remind ourselves on the narrative that's out there on the street. And so while we're taking a quick look at that, maybe I could have each of you guys in turn, and maybe Al, you can go first. Just so you could summarize, like if we walk away from this webinar and from this conversation, what are the 2 or 3 things you hope to really remember?
Don't underestimate the Chinese comeback. Don't think that's played into the market, whether it's Xi promises or we can get the specifics of what the GPS data is telling me, but directionally, it's going back to normal, right? So first, don't underestimate Chinese comeback. Second, watch out for the pent-up demand, right? I mean, I've seen people say this is not a U-shaped recovery, this is a V. And to me, again, a motivated Chinese consumer with stimulus and weak interest rates, and that to me is a very important bullish combination that may materialize. So those are 2 at the top of my mind.
Sir?
From my on the supply side, I think I would say, right now everybody is in wait and see mode. They're not changing their programs yet. The public companies are not changing their programs yet. They are waiting to see what the actual numbers look like, the lagged numbers when they get it, and they're also seeing what the rebound in prices is going to look like once hopefully this Chinese demand and the Chinese comeback materializes, as Al mentioned. So at this moment in time, it is a wait and see, but everybody has come out and said that if a prolonged period of low prices exists, they will take that into consideration and they will decrease activity. They're not afraid to decline. That's just the world that we live in now, where free cash flow is king. So nothing too out of the ordinary, but it is wait and see mode, and the different scenarios that we build around our production forecasts are going to be more important than ever in being able to understand the impact on production of the different commodities in the end.
Awesome. Well, thank you very much. Try and give everybody back the last 10 minutes of the hour here. We really appreciate the time. And for me, I think it's tremendously exciting to be part of this combined team and to see the great work that both sides of the fence here are being able to bring together and really add to the macro products that we were discussing today. So thank you, Sarp. Thank you, Al, Judith, and everybody that joined us today.